G'day everyone, welcome to this update for Australian and global markets for the 28th of June. And it was another week of the same. We had not much net movement in Australia, but plenty of volatility, and not much net movement in America and very little volatility. It was the 8th straight week in a row where the US market from top to bottom moved by less than 1%. So nothing much has changed, and nothing much has really changed with Greece either. As I indicated last week, the two main drivers for global markets at the moment are what's going to happen with Greece and when the US Federal Reserve is going to start to raise interest rates. That is the focus of markets at the moment, be that right or wrong. It's just the way that it is. Now, I understand this morning, being Sunday, that the negotiations over the weekend with respect to the Greek debt repayments have basically collapsed. I did note some signs of people queuing at ATMs on Greek banks to withdraw their money. So there's quite a distinct possibility that Greek banks will not be able to open on Monday. And who knows what the fallout from that will be. But look, I can tell you that whatever the fallout is, it'll be more panic related, so it'll be emotionally driven and therefore be short term and probably quite transient rather than something of real substance. The Greek economy is just too small for it to be any other way, and you can't imagine, if there is any fallout in financial markets, that the ECB, which has spent the last 3 or 4 years doing everything it can to get things pointed in the right direction, are just going to stand back and let it happen. If there is any fallout, the ECB will step up big time and stabilise the markets. So I think the likely outcome is that we might get some short-term disruption based on emotional panic decisions, and then life will just fairly quickly get back to normal. So my overall view is that any disruption in markets is probably a good buying opportunity. However, you've got to be very, very careful and specific about what it is you're buying. So let's get on and have a look at what happened last week. The S&P index in America ended up losing just 8 points on the week. And as I said before, it's the 8th successive week of sub 1% movement. As you'll see from the chart, the overall trend remains intact. And I think, interestingly, the options market is not really showing any signs of people wanting to buy additional put option protection or to take some downside protection. The options premiums have hardly moved, so I think that's a bit of an indicator. We'll also look at the Nasdaq and the Russell 2000 indices as well, just to get a sense of what the broader market is doing. The Aussie stocks, the ASX 200 index lost 51 points on the week, and that was after we gained 52 points the week before. So we're precisely back where we started from. But the volatility on a day-to-day basis was substantially higher than America. And there's really a lot of stocks that are under a lot of pressure in Australia. And when you look at stocks like Wesfarmers breaking absolutely critical support, it really does tell a story about where the Australian market is going at the moment. And as I've pointed out before, close to 40% of the Australian market is represented by overseas money. So if they decide to take their funds out from these stocks that have been supported very well over the last 2 or 3 years, then that's going to have a very significant impact. So from my perspective, it's very, very difficult to see 6,000 points this year or even in 2016. I know a lot of commentators are saying that 6,000 points is going to be achieved, but look, I don't think they're looking at. I think they're looking at the reality of the situation. I think they're just looking at where the index is at the moment, and they're adding on 5% or 8% or something like that, because that's what the market always typically does. I think we're at a stage now where the Australian market is going to go through a very, very significant change to what we've seen over the last few years. The fundamentals that have driven share prices in the Australian market are changing rapidly. and I just can't see how 6,000 points is going to be achieved. Now, the energy and materials indices are really breaking down from their consolidation, and we'll have a quick look at those as well. So lots of charts to look at this morning. Let's get on with it. We'll start with the S&P 500 index, and this is on a daily chart, so you can see that the uptrend remains very much intact, and the daily ranges are pretty small, and this price action is getting tighter and tighter. So it'll be interesting to see how the American market responds to any fallout from Greece. But as I said, I really see it as a buying opportunity, not something to be feared. But obviously you've got to go into such situations with a level of cash, and that's what I've been advocating now for many, many months. Let's look at the NASDAQ index. You can see still a very, very strong uptrend. Yes, it was down a little bit on Friday night, but there's still a very clear uptrend in place. We've got a bit of a consolidation over the last 2 months or so, but there's really no signs of a significant change there. And just to complete the US market, this is the Russell 2000 index, which is the smaller cap, mid to small cap stocks. And again, you can see that we've got a good uptrend in place. The value of the index is well above the moving average, indicating strength of trend. So there's just really no signs at all in that market of a problem. Looking at the VIX index, this is the long-term VXO on the Nasdaq 100. Sorry, on the Nasdaq 100. And you can see that we're still close to the bottom of the typical trading range. So the absolute base of the trading range tends to be around about the 10 to 11 to 12 mark, and we finished the week at about 14. So still really right down in the base area. Now, just before I look at the Australian market, I just want to look at currencies because they're obviously important. This is the US dollar index. So you can see that we had a real, really strong acceleration in the US dollar, which really peaked out in March of this year. Since then, it's retraced a little bit as some strength has come into the euro, but that's really consolidated now over the last few weeks, and you'd have to think that there's going to be pressure on the euro. So the drivers for me are going to continue to push the US dollar to the upside, and of course that should mean that the Australian dollar will head lower. This is the Australian dollar. This is an ETF of the Australian dollar. So you can see we've had a very, very substantial fall. We've had a consolidation between 76 and 81, and we're back down to the bottom of that range. And when we look at the indices in Australia for energy and basic materials, so all your commodity price stocks, then it's pretty clear why the Australian dollar is going to continue to be under pressure. So turning now to the Australian market, this is the materials index. So we'll look at the materials and energy and banking. So you can see the materials index really struggling. It's done absolutely nothing for several years now, and a very significant move to the downside on Friday. That really was pretty nasty, and I think that was a little bit related to a 5% plunge in the Shanghai stock market. If we look at energy, also did the same. It's been a big plunge from 2014, and then we've consolidated recently, but again a sharp move down on Friday. Looking at the ASX 200, so if we pan back here, you can see there's still a sort of a big picture uptrend in place, but really within the time span that most people are operating, you can see we're forming lower highs and lower lows all the way through here. Quite clearly a downtrend, and Thursday and Friday were pretty nasty in the Australian market. I mentioned Wesfarmers. I'll just highlight this because this is a really, really important support level. You can see this level here, just under $40. It was created by key reversals from 2007, 2008, and all the way through here. So this is a very, very significant support level. The stock has been able to hold above it, other than one brief excursion in 2013. The stock has been able to hold above this line for 2.5 years. And I think it's not coincidental that we got a breakdown on Friday. Now, it's only very preliminary at this stage, but it's just not a good sign when the Australian market's been sold off as much as it has already. Turning now to gold, lower by $25 for the week. And look, nothing has changed here. We're still stuck in this big picture wedge pattern, which is downward sloping. And so therefore the odds, I'm not saying this will happen, but if I had to flip a coin and say which way is it going to go, is it going to go to the upside or the downside? You just have to go with the downside. That's where the odds are currently leaning, and that brings gold price of $1,000 into play. And we're still seeing stocks really leading the way down in commodities. It's in gold, I should say. So let's look at the gold. This is US dollar gold price. So this is on a daily chart. So we had some sharp falls Monday and Tuesday, and then it stabilized a bit towards the end of the week. But if we look at it on a weekly chart, you can see this downward sloping wedge. And yeah, there's just really no signs of a rebound there at all. And if we look at the HUI as one of the gold stock indices, then you can see it's also looking pretty weak and shaky at the moment. So just to finish off, copper steady around $2.60 for the week, and as I pointed out last week, it's really just pointing to the global reality about growth, and growth is going to be substandard, and it's going to be fairly anemic for a long period of time to come by the look of things. Crude oil still stuck around 60, but I still expect lower yet. We haven't seen the washout of production yet that is really needed to put a floor under the oil price. There's the spot copper chart. Hasn't moved much during the last week. So overall, looking at the Australian market, we're starting to see a wave of profit downgrades now as the economy slows. Clearly Woolworths is in trouble, and we've seen downgrades from a number of other stocks across a wide range of different sectors. So I don't think the full year reports that'll start coming through in August this year are going to be particularly pretty, and I think we'll see some analyst downgrades before then. So the sentiment around the Australian market is really quite poor. Members of specialist share education obviously are very clear on what they need to do and what the strategy is. If you're not a member, then just exercise extreme caution in the Australian market. I really do not like what I'm seeing. I don't like to say that, but it's just the reality. The odds favour a US index breakout to the upside, but short term, what's happening with Greece is very unpredictable, and and the market reaction to what's happening with Greece will even be more unpredictable. So you've just got to pull back. You've got to understand the fundamentals of the stocks that you're buying. You've got to understand value, and you've just got to be patient and don't be tempted to try and make something happen during a period when markets aren't advancing. That's the worst thing that you could do. So that's it for this week. Anyone that wants to contact me who's not a member, who's interested in understanding more about how I go about things, there's my contact details, and I'll be back with you next weekend. Cheers.